We're good to go, Susan.
Good morning. I'd like to welcome everyone this morning joining us in this virtual program, in this virtual format for our program today. I'd like to especially welcome our dear guest, Alejandro Werner, Director of the IMF International Monetary Fund's Western Hemisphere Department. I am not going to spend a lot of time giving you his background because everyone knows Alejandro. Every year he comes to the Council of the Americas in January or February and shares with us his yearly economic outlook. And while today we're virtual as opposed to being in our offices at 680 Park Avenue, he has again agreed to come and share his economic outlook. So without further ado, I'm going to pass the microphone to my dear friend, Alejandro Werner, who is going to give the IMF's perspective on the economic outlook for Latin America. Alejandro, I pass the microphone to you. Thank you so much for joining us.
This presentation, we do a chat with somebody on the perspectives for Latin America and for the world, and I think it was a great idea on your part to do it again this year, now in the virtual format, and hopefully next year we'll have it again at your offices with your staff and enjoying a dinner afterwards. But having said that, let me give a brief presentation of what's our updated outlook for the region. Basically, around 10 days ago, our chief economist, Gita Gopinath, presented our updated world economic outlook, where she basically presented the reasons behind our upgrade in our view for the world economy. As you can see, we're expecting now the world to have contracted by around 3.5% in 2020, with an important upward revision for the U.S. outcome with a 3.4 contraction in 2020. We have been revising upwards the expected growth for the U.S. throughout the year after the pandemic erupted. We're expecting the euro area to have contracted 7.2%, Japan by 5.1%, and emerging markets by around 2.4% contraction, but with China growing at 2.3%. And for 2021, we're expecting the world to jump up by 5.1% with the world by 5.5%, the US by 5.1%, the United Kingdom by 4.5%, the euro area around that, and then China growing at around 8% this year. What is behind our upward revision for the world economy? I would say two or three things. On the one hand, we have seen that the world economy has adapted a bit better to living with the pandemic than what we originally thought. So gradually throughout the year, we have been seeing economic outcomes turning a bit better than what we expected. When we look at Q3, almost every country in the world had a better Q-on-Q growth than what was implicit in our forecast for 2020, showing both that maybe policy stimulus was larger and a bit more effective than what we assumed, but also that in the service sector, the economy was adjusting better than what we expected, and even more so than the service sector. In the manufacturing sector, the adjustment was much better than what we thought. On top of that, we have in 2021 this race between the vaccine and the mutating virus, that at the end of the day, we expect vaccines to outperform the mutating viruses. And in that sense, we are seeing a second half of 2021 that should be relatively good for the world economy. All of this in the context in which we continue to expect important monetary policy support, and especially in the case of the US, and that is not embedded in our current forecast, the possibility of another dose of fiscal stimulus impacting the US economy. So those are, the main elements behind our revision for the world economy, that obviously in terms of growth is good for Latin America as well. When we look at how the pandemic has been evolving, all of you know, we have seen an important new surge in cases and deaths in Latin America, and that's what the first two panels of this graph show. Basically, moving averages of 7 days, both of cases and death rates for Latin America. And there you can see that almost for all the regions, South America plus Mexico, Central America, and the Caribbean, we saw an increase in cases and an increase in death, except in the Caribbean, with death rates have been very, very flat and well contained. And the last graph in the slide basically presents the cumulative death rates and cumulative cases rate, basically showing that Latin America has been performing on the pandemic side pretty poorly and showing high contagion rates and high death rates, similar to the ones we've seen in Western Europe and in the US. Let me just provide some data collected first by the University of Duke on supply contracts of vaccines for Latin America and other countries. That's what you can see in the first graph, basically showing that only in the cases of Chile, Costa Rica, and Mexico, governments have announced that they have contracts established already to cover all of their population. In the rest of the cases, in countries in Latin America, countries have not been able yet to secure an important supply of vaccines to eventually roll out a vaccination program that covers the full population. And as you can see in the last chart in this graph, basically we're showing that how the deployment of these vaccination campaigns have been evolving in Latin America compared with the US and Great Britain. Basically, we have been doing very poorly yet, but we're expecting these vaccination campaigns to accelerate, especially in the second quarter of this year, giving way to an important increase in coverage in the second half of 2021. Again, looking at the impact of the second surge of contagions on mobility in Latin America, after, a very slow upward climb that started in April, May in terms of mobility, we started seeing in December an important reversal, basically reflecting what we're seeing on the right-hand side of your slide, basically the significant increase in cases and death rates in Latin America, that driving the recovery in mobility to stop and eventually to reverse. And that will, we think, show up in Q-on-Q growth rates in the first quarter of 2021. So basically, we're expecting 2021 to show a little bit of a step backwards in terms of the recovery in 2021 in the first quarter, and then hopefully on the back of a containment of the advancements of the pandemic and eventually deployment of vaccination in Q2 and Q3, Latin America to come back to the recovery path that we were seeing at the end of 2020. Let me now turn to some numbers for Latin America. We have seen economic activity bounce back pretty quickly in Q3 and Q4, and that has continued. We expect that to continue throughout 2021. The services sector lagging the manufacturing sector and the industrial production that has basically fully recovered to the levels of end 2019. Retail sales doing relatively well in some countries, maybe highlighting the case of Mexico, that has provided much less support than other countries, and therefore, consumption has been lagging the recovery that we have been seeing in other countries in the region. And then, PMI indexes clearly showing an important recovery throughout 2020. I think the slide that I just, this one just trying to illustrate the important support that international financial markets have provided to Latin America. We have seen basically sovereign issuance in 2020 being much larger than what we saw in 2019, and corporate issuance being almost the same as what we saw in 2019, and markets reopening, as we can see in the last slide, first in March and April for investment grade countries, but then after that opening up also to high yield countries throughout the year. And the same thing has happened with some of the main corporates in Latin America. What we have seen is some differentiation between the local markets, local currency inflows, and hard currency inflows. Basically, capital flows being driven much more to foreign currency and foreign law issuance rather than capital inflows to the domestic market, although we have seen some uptick, especially in Colombia and Brazil, of basically the holdings of foreigners in domestic sovereign debt. Now let me turn to our forecast for the Latin American economies for 2021. We're expecting Latin America to grow at around 4.1. We're expecting Argentina to recover at a rate of 4.5%, Brazil 3.6, Colombia 5.8, Peru 9, basically having had such an awful second quarter this year that obviously is playing in reverse in 2021, and Mexico growing at around 4.3% per year. I would say that also the cases in Peru and Chile are being held by the significant withdrawals from the pension funds that, although we think from the medium-term institutional perspective, undermining the pension systems in this way is not a favorable development. From a short-term economic performance point of view, that will be supporting a little bit the recovery of economic activity in the first half of 2021. If we turn to the important issue of public debt in Latin America, we have seen public debt increase by around 10 percentage points of GDP on average. When we look at the gross debt numbers, they're pretty confusing if you try to match them vis-a-vis the deficits that we saw in 2020. On the one hand, because obviously the denominator, GDP moved in very different ways. We have a very sharp contraction in Mexico that had a much more conservative fiscal policy. And on the other hand, we had GDP doing significantly better in Brazil with a much larger deficit. And on the other hand, also, some countries made use of important cash deposits that the federal government had at the central bank. And that basically significantly reduced the reliance on issuance of new debt. So if we were looking at net debt, we will be seeing, for example, a much larger increase in debt to GDP ratios in Brazil. So also one has to take this into account when one looks at the evolution of gross debt between 2019 and expected gross debt in 2021. I would say that during 2020, I think everybody underestimated the fiscal space that countries had, because we underestimated the liquidity support that advanced economy central banks were going to provide during the pandemic, and this significantly opened the door to a much more aggressive fiscal policy in several EMs. And I think also the significant decline in investment and increase in domestic savings that also opened the door for financing of these large public sector savings. As we will see a little bit further down the presentation, it is also important to notice that when one looks obviously at sovereign debt, there's a significant increase, but when one looks at the interest cost of debt, still it's relatively well contained in the next few years in Latin America, suggesting that carefully managed fiscal policy still might have some room to provide support during 2021, and in some other cases to provide support in those countries in which maybe the recovery doesn't pan out to be as strong as some governments were expecting at the beginning of the year. In this chart, we show the average and country by country fiscal support, above the line support that Latin America has done. We break it down into the direct support for households, for businesses, and other types of support like support to the health system, etc. We can see how on average Latin America supported the economy from the budget by around 4.5 percentage points of GDP, with Brazil doing around 8% and Mexico doing maybe around 0.7% of GDP. When one looks at the composition, also the case of Brazil stands out as being much more biased towards households than firms, compared, for example, in the case of Chile or Peru. When one looks at the deployment of primary expenditures through time, one can see how in Brazil and Colombia, primary government expenditures reacted quite quickly after the pandemic. So we're seeing that already in Q2, the growth of primary expenditures by the governments were increasing at a significant pace. Something different happened in Peru and Chile, where although announcements were made, basically the deployment took a quarter to get off the ground, and we see some lags between announcements and implementation. Let me turn to this next graph, where basically we discuss fiscal space. On the right-hand side, you can see how, although the blue line that shows a significant increase in the debt to GDP ratios is reaching, relatively high levels for Latin American standards, when one looks at interest payments over GDP, they continue to be, when we look in nominal terms, are relatively low levels compared with what we have seen in the last 20 years. And when we look in real terms, these payments are around what we are seeing in the US, obviously with much lower levels of debt. Basically, as you can see on the chart on the left, almost every country is expected to significantly remove the fiscal stimulus in 2021. Almost every country is above the diagonal. And I think the argument we have been making is that, countries have to calibrate extremely well the removal of a stimulus to continue to support the most affected households and firms, doing this stimulus in a much more targeted and fine-tuned way. Also putting an important eye on their access to financing and their financing conditions. And in this trade-off, I think maybe in some countries in the region, we have seen that there might be a little bit bias, more than what is available, to think that their fiscal space is smaller than what it is. What we have also claimed is that, to support the creation of this fiscal space, important legislative or policy announcements will be important to guarantee that the medium-term fiscal anchor will be met. So in that sense, to the extent that countries are able to increase the credibility of the medium-term fiscal anchor, then the short-term policy space might be a little bit bigger than what we thought. Just to conclude, from the monetary policy side, we saw central banks in the region acting very aggressively by lowering rates and announcing also liquidity support measures for the financial system. We think this is completely warranted. We think that, most countries will be able to continue to maintain rates significantly below neutral rates for the next 12 to 18 months to continue to support the recovery. And inflation expectations, as you can see on the right-hand side, have been extremely well anchored as well. For 2021, as I said, we have, three forces that will be heavily weighing on the outcome. One is this issue of vaccine rollouts versus the mutating virus that we think also in the region, especially by the second half of this year, we will see the vaccine rollout to start to get significantly ahead of the virus. That's implicit in our forecast. Secondly, we have, this discussion between policy support and market access. Hopefully, some governments will be able to put together packages that at the margin provide obviously a smaller amount of support than what we've seen on average in 2020, but maybe more support than what they have announced. And at the same time, stronger commitments for fiscal consolidation in 2022, but especially in 2023. If these commitments can also be supported by legislative action, this will be much better to anchor sustainability perceptions and therefore make this whole package much more powerful. And third, this is the start of an important political electoral cycle in Latin America. We're having, yesterday there were elections in first round elections, presidential elections in Ecuador. There will be legislative elections in Argentina and Mexico, and there will be presidential elections in Peru and Chile. So that will also weigh in terms of expectations, generating a bit more uncertainty. And therefore, the region is facing, I think, an important and very challenging year. From the medium-term perspective, what we have said is by the end of the pandemic, Latin America will end up in a situation in which basically GDP will not recover 2019 levels until 2023, GDP per capita levels until 2025. This pandemic is hurting much more low-income households, women, youth, obviously having significant effects on poverty and income distribution. So when we think of the post-pandemic world, we will have significant public finance pressures, coming from increases in debt to GDP ratios. We will have significant social debts because income distribution would have deteriorated, poverty will have increased, and obviously gender issues, youth issues, etc., will be weighing on social issues in Latin America, and therefore opening up the door for the renewal of social tensions. And obviously a heavy electoral calendar. What many analysts have been saying is Latin America will have to find a way, or many countries in Latin America will have to find a way to negotiate, to discuss and eventually implement a new social contract that basically focuses much more of expanding public healthcare systems, strengthening public education systems, all of these within a fiscal envelope that should be reinforced by increases in efficiency of public expenditure, but also in strengthening tax revenues of several governments in Latin America, but to regain growth, employment creation, and investment. This should be coupled with productivity enhancing reforms that would significantly increase the incentives of the private sector to invest in Latin America. And therefore, this will need a very broad social consensus that some people have called, let's say, the negotiation of a new social contract for Latin America to be able to come out of this crisis growing at much faster rates, and not only growing faster, but doing this in a much more inclusive way than what we have seen in the past. So with that, I will conclude my initial remarks, Susan, and we can turn to the Q&A session. Thanks.
Well, thank you very much, Alejandro, for your comments. I'm now going to open the floor to questions. And as we have a first question, so I don't get to ask the first question. June Weber, you have the first question. Please open your microphone and ask the question.
Good morning. Good morning, Susan. Good morning, Alejandro. I hope you're both well. Alejandro, my question was about specifically about Mexico. Obviously, you've highlighted the very low support that fiscal support that's been given by the government during the pandemic. Now, AMLO has sent this electricity initiative to Congress, a kind of a counter reform. What impact do you think that will have on the economy, both on confidence and on growth?
Okay, so yes, thanks, Jude, for your question. Yeah, definitely we, as I said before, we continue to think our team that visited virtually Mexico in September of last year and put out the report, I think in October, November of last year, was convinced that Mexico had more fiscal space, and Mexico had built buffers in the past to deploy them during the pandemic. I mean, Mexico is one of the countries that has actually followed very well and implemented very well what people call this saving for a rainy day, by basically having contingent credit lines, by having a well-managed public debt, by being pretty predictable and serious in the use of its public resources. So I think this is the rainiest day that you can think of when you have, I mean, a drop in employment of around 20% in the second quarter of last year, where you have a significant increase in poverty, and you have one of the largest declines in GDP and GDP per capita in the history of the country. So, and you had access to international capital markets. So definitely at that time, the team thought that an additional stimulus of around 3% of GDP would have been possible. It would have reduced the contraction of the economy, and would have supported many families and small and medium-sized enterprises. And in the case of these enterprises, to be in a much better position to recover when that the economy starts to reopen, and therefore to minimize scarring of the pandemic. That's another important issue. The capacity of these economies to recover once we start going back to normality. If we had a much larger number of bankruptcies, of closures, of breaking up labor relationships between stores and workers, etc., will be much harder to restart the economy. So because of all of those reasons, we thought that would have been really well spent, but well, that did not take place. We still think that there's scope in 2021 to do something similar, especially given the lack of containment of the pandemic. We would like to see countries supporting the most affected households throughout these stages of the pandemic, and also the most affected firms. Turning to your second question, I mean, we obviously, our teams have not done a detailed analysis, and even less of an analysis of the impact of this reform proposal on the economy, but we did study the previous reforms, and we did study the setup of the electricity system in Mexico. And I think the view of the teams that did this analysis a couple of years ago was basically that Mexico now had the framework to continue to build an electricity system that basically was going to be able to generate electricity at declining marginal cost, and therefore at declining prices, eventually both for households and firms. At the same time, to significantly diversify the sources of generation of electricity, therefore making a potential blackouts and supply problems much less likely than in the past. And third, also generating a system that was fostering the increasing supply of renewable energies that will also contribute to low-cost energy, but will contribute to fight climate change and will contribute to adjust the Mexican economy to an eventual future world economy that will be demanding countries to provide a significant amount of its energy from renewable sources. From a very preliminary analysis of this legislation, I think several of those elements and characteristics of the previous system might end up being affected, and therefore affecting Mexico from the point of view of its capacity to implement policies to fight climate change. It will also significantly affect the capacity to continue to generate energy at lower costs, and therefore not helping to increase the competitiveness of the Mexican economy. And also, increasing eventually in the medium term the probability of blackouts and significant shortages of energy in the Mexican economy. So yeah, this will not help, as you say, turn around the important stagnation that we saw first, but significantly in the last 2 years, a significant drop in investment and private investment in Mexico, both because of its direct effects by eventually increasing the cost of energy, but more than that, by significantly affecting uncertainty when you keep on changing the rules of the game for private sector investment in the country.
Thank you very much. I have a question. So you talked about fiscal consolidation, and you also talked about a new social contract and what's going to need to happen. Generally, in the history of Latin America, those two things have not been consistent. In fact, they've been relatively inconsistent. How do you see both of those things actually happening? I agree with both of them, but that would be very challenging because a new social contract would include new social costs, no?
Yeah, no, your question is very good, because maybe I mixed these concepts and I talked about them a little bit loosely. Let me say first, let's leave the social contract aside, a new social contract aside for a minute, and let's just look at what the economy needs from a fiscal point of view. And I think having still in 2021 a very large output gap in Latin America and having a very wide social gap, because you can close, you might be able, hypothetically, that's not going to happen in Latin America, but close the output gap. The economy, let's assume it's operating at full potential, but you can still have an important social gap, because maybe many of your workers that were employed in 2019 are still unemployed. And maybe even if you reach full employment, that new full employment is not incorporated women and youth at the pace that you would want. However, in 2021 in Latin America, you will have both of these problems. You will have a very wide output gap. Output will be significantly below capacity throughout Latin America. And at the same time, you will still have had a significant deterioration of any social indicator that you want to pick vis-a-vis the level that you had in 2019. So in that sense, I think economies in Latin America will still benefit from some stimulus and support from fiscal policy. The big issue is when you have levels of debt to GDP between 65 and 90% of GDP, trying to help can generate unintended consequences if markets shut down for your country. So the big question is, how can you generate the fiscal space today to support those families and to support aggregate demand without scaring markets? And I think that's where I said, well, what you need is a stronger commitment that in the medium term, as the pandemic fades away, eventually you will go back to public finances that put the debt to GDP ratio in let's say, a stable path. And for that, you will need some fiscal reforms, both maybe on the income side and on the expenditure side. But that will allow you to do more for your population and your economy today. That's one thing. From a medium-term perspective, this pandemic also made it much more clear the significant deficits in some public services that Latin America has. One of them is obviously public health. Another one is education. And we will come out of the pandemic with a huge educational gap. I mean, the gap between private schools and public schools and kids that go to one or the other during 2020 and 2021 will have been huge. The gap between those kids that have access to very good internet access and those that don't will end up being very, very large. And in the medium term, these effects will continue to weigh on Latin American economies and will continue to affect income distribution and poverty levels. So both on education and public health, it is very clear that we have to do much better. That will need structural reforms, but maybe it will also need more resources. And as you say, you will need more resources, then you will need tax reforms, fiscal reforms, etc. I think this could be maybe one of the few times in which you put in the table, let's say, a public finance reform with a significantly progressive way of using those resources. So in a way, if you can put the choice to the population as basically, doing a public finance reform, but basically to broaden public services in health and education, maybe this time we will have a much better chance on advancing on these reforms. But also, it's very important to link this with reforms that will make it much more feasible for the private sector to do its role. Because if we're going to be doing a public finance reform, if these economies were not having a huge GDP growth rate in the past either, and we're talking about increasing the size of the public sector, even if it's for good things, we have to open up spaces for more private sector participation, because the public sector will not be able to invest, will not be able to do many things. So this also has to come together, and this is very country specific, with opening up spaces for the private sector to do more and to do things better. So it's, as you say, it's really a grand bargain. It's hard to envision today where do you have the political climate in Latin America to embark on in this type of very ambitious efforts, but that will be the challenge that Latin American societies will have to face in the post-pandemic world. And hopefully many of the countries in Latin America will be able to be successful in this.
Thank you very much. We now have a question from Inigo Ortega from CFA.
Thank you, Alejandro. For your presentation. I wanted to ask you about some of the that have been happening in regions, and what are your thoughts on those? And also some of the backlash for private pension and the movements that are happening there. What are your thoughts?
Look, I think there's a medium-term need to continue to strengthen the pension fund systems in the region. I mean, if we have we as economists, a good diagnosis of changes that are needed for the pension systems in Latin America, I think we have plenty of them. And I think there's significant agreement on what needs to be done to increase contributions to these systems so that replacement rates could be higher, to move to a system that better incorporates behavioral elements by workers, that make these systems a very complex system that cannot be dealt like a traditional super open competition market, because workers, the average worker, does not have enough information to choose who would be the best fund manager for themselves. So we have to do much more in terms of communication, in terms of financial education, in terms of transparency, etc. And also we have to continue to move the system to a situation in which it has many more choices to invest these resources in, and also to continue the reduction in fees from these systems. However, I think continue to undermine these systems by allowing significant withdrawals from it actually deepens the medium-term problems, because replacement rates then will be lower. So I think in that sense, it's a counterproductive movement to allow these indiscriminate withdrawals. I think there are better ways to use the pension fund resources to continue to support the recovery in these economies. I think the intention behind many of these policies maybe is not wrong, saying, look, we have a significant amount of savings in these pension funds, in these institutional investors that can be mobilized to help their recovery. And there can be more creative ways to deploy these resources without undermining the medium-term sustainability and strength of this system. Let's not forget that these systems have been key to significantly support investment in these economies, long-term investment, by providing a very solid base of institutional investors that actually have a long-term horizon. So I think we have to continue to do those reforms, and we have to look at creative ways to use, in cases of sharp negative shocks, to use the resources of these funds to support the recovery, but without undermining the financial strength of the system. I think that's an unintended consequence that can end up hurting these countries significantly in the medium term.
Thank you very much. Thank you very much. John Negroponte. Next. John, can you unmute your microphone? John, can you unmute your microphone, please? Yes. Yes. We can't hear you, John. We can't hear you, John.
Okay, now you should be. Okay, yes. So my question, Alejandro, well, first of all, thank you very much for speaking to the membership of the Council of the Americas and the American Society. I wanted to ask you about the impact of the COVID crisis on the economies of the countries that are almost exclusively dependent on tourism. I guess I have in mind mostly the Caribbean countries, but what's your assessment of the impact on them, on those countries, and the prospects for recovery?
Thank you, John, for your question. I mean, as always, you have picked an important hole in my presentation. I think not speaking about Central America and not speaking about the Caribbean was an important gap on my side. I think let me just use your intervention by I mean, as always, I mean, you've been extremely diplomatic instead of saying, I mean, how do you dare not talk about what's going on in the Caribbean and Central America? Let me just say that in Central America, I want to highlight the importance of the unexpected surge in remittances that we have seen to support the economies, and also, I mean, the structural aspects of the Central American economies being more biased towards agriculture, and in that sense being better placed to handle the pandemic, although obviously the impact has been very important in Central America as well, also generating an environment in which migration flows to the U.S. Can significantly accelerate in the next few months. Turning to the Caribbean, I think, as you said, the situation in the Caribbean is very, very dire. It's the sub-region that is most affected in Latin America and the Caribbean. We're expecting drops in activity between 25 and 10% in the tourism-dependent Caribbean. Significant unemployment, significant fiscal problems as governments have been trying to support the unemployed and the households that have been mostly affected. And throughout, 2020, some governments have been able to do something, basically drawing on concessional financing. We have provided important financing to the Caribbean by around $1 billion. Most of that emergency financing and some expansions of programs that we already had, like the one in Barbados. On top of that, there were significant resources coming from the World Bank, the IDB, and the Caribbean Development Bank. But I think a lot of that was basically a design in an environment in which many Caribbean governments were thinking that by 2021, the pandemic was going to be over and tourism was going to come back with a speed that it is not going to happen now. So to me, it's very important for many Caribbean countries to move relatively quickly to put together macroeconomic programs that will signal that starting in 2023 or whenever tourism is back at 80% capacity, that they will have the taxes, the expenditure savings, etc., to consolidate the public finances, but 2023. But that will support programs in 2021 and 2022, where they will have very large deficits, and the financing for those deficits should come from us, from the World Bank, from the IDB, the Caribbean Development Bank, and in those cases in which countries have access to international financial markets, and their programs are credible from the beginning, because governments will legislate that starting in, as I said, in 2023, they will reestablish public finances that will be equilibrated, and also that those programs are supported by the international community, not only with moral support, but with financial resources, might open the door also to flows from the private sector through the international capital markets. I think it's very important for the region to move much faster to put in place those types of commitments, and we will definitely support them if they reach out to us, basically to ask for financial support for that kind of policy packages. We're extremely open to discuss with Caribbean countries packages that have relatively large deficits in 2021 and 2022, and those deficits are started to pay it back in 23, 24, etc. Are very different programs from your traditional IMF program. But a traditional IMF program basically happens in a country that has run a very unequilibrated public finances in the past and needs an important adjustment in the present to get the country back on its feet. Now what we have is a global pandemic basically affecting those countries so hardly that now they don't have any other option rather than to run important deficits to continue to perform the functions of government and support their populations. And what we would like to see is a commitment to future normalizations when we start seeing tourism to go back to important levels, and at that time consolidation and normalization should start. So hopefully throughout 2021 we will be able to work with the region in putting together these types of programs. And obviously, within those programs you will also want to see some structural measures associated to strengthening the diversification that these economies can achieve to make it a little bit less vulnerable to future shocks like the one we have seen today. And in this whole context, obviously the Caribbean is also one of the regions in the world that it's most exposed to climate change. And therefore, we have already been working with them basically to establish programs to build resilience in these economies. And obviously within these programs that I have been talking, part or an important part of diversification and the recovery of these economies would be to put in place a resilience building infrastructure in the Caribbean. And that should also be part of the recovery of these economies in the next 2 years. Thanks, John.
Thank you very much.
Thank you very much.
Vanessa Rubio, next. Please unmute your microphone. Vanessa, we can't hear you.
Thank you. Thank you, Alejandro. Thank you, Susan, for such a great presentation and great information. Just 2 points that I would like you to go deeper, Alejandro, if possible. The first one, you mentioned Brazil and Mexico being the outliers in the region in terms of fiscal support. Brazil in the one hand with 8% and Mexico with 0.7%. It is very difficult sometimes to imagine the contrafactual. But can you tell us how would 2020 and how would 2021 would have looked in the case Mexico would have given fiscal support in the context of what the IMF was proposing around, you said 3 points more, so that I guess that would be somewhere around 4% of GDP last year. But I think this contrafactual is quite important, particularly to given what you said, that since the pandemic is still going to be hitting hard this year in Latin America, in Mexico, and Mexico is a part of it, there is still room for fiscal support for 2021. I mean, still the government could react and could create a new fiscal support for the country to address the vulnerable, address the SMEs, address unemployment, and hopefully growth. So what's your thought about it? And finally, you said you thought that we needed to still reduce fees in the pension system. I think that that's definitely the case. But I don't know what your opinion is. I think that should be done by promoting competition and, as you said, financial education and other measures, different than price controls or price caps for the financial system. For your answers, thank you, Alejandro.
Start from the part of the part of the question where I disagree with you. I think the pension system should have a non-negligible dose of regulation and regulation on the fee part of it. I think just the pure competition model that several countries experimented with, thinking that competition will drive us to lower and lower fees, ended up in a situation in which we had relatively higher fees, a lot of expenditure on marketing, because at the end of the day, workers did not know that well how to choose among different pension fund managers, and ended up basically moving too much and being significantly driven to change fund managers by marketing practices rather than the ability of these funds to generate excess returns. So I do think that maybe the system needs a stronger dose of regulation to continue to reduce fees in some of the countries in Latin America. I agree with you that this fee should not be set in stone in legislation, etc. But I think we need maybe a slightly heavier hand approach to the regulation of fees in Latin America to help the reduction. I would say that on your other questions, I mean, I totally agree with, I mean, you pose them as questions, but basically you want me to say that Mexico would have grown at X% higher rate, and that would have been the case. I mean, look, I said 3%, a 3% fiscal package, and that's what it's included in our Article 4. That's the conclusion that the team that went to Mexico reached. From a macro side, you can think of multipliers. Maybe being around, being conservative, being around 0.5 and 1 for the case of Mexico. If these packages would have been put in place, so anybody can do the math and get to the growth rate than one would think Mexico was going to have by just doing the multiplier by the fiscal impulse. But more importantly than the fiscal impulse, the multiplier and GDP, I think is the number of families that could have been helped. I mean, you look at the case of Brazil, in which, I mean, maybe obviously the support was very, very large. But when people are doing simulations on the impact of the pandemic on poverty levels in 2020, people are coming out with a result that basically there's not going to be an increase in poverty in Brazil due to the fact that they implemented these very aggressive social programs. So in that sense, even in a situation in which GDP would have contracted by less, but not so much less, if during a period in which you ask a lot of workers that have very low wages, that they have no buffers, and you ask them to stay at home to minimize contagion in society, you would have been able to reduce the increase in poverty by 5 million or by 7 million. I think the impact is very, very large, both from a social point of view, from a medium-term growth capability, and from a social cohesion and political cohesion point of view. So I think it would have been very, very important, looking especially at the results in Brazil, from the impacts of these programs on poverty and on social indicators, the deployment of similar type of measures in those countries that did have the fiscal space and did not implemented them. And obviously it would have shown up in GDP growth. I mean, our Brazil team, using, let's say, a multiplier of around between 0.7 and 1, estimates that around between 3 and almost 4 percentage points of growth in Brazil in 2020 were the product of the whole array of supports that the government put in place. So in the case of Brazil, I mean, we would have seen a contraction of around maybe 8% of GDP in the absence of support. So we think it's a very important tool. We have seen it around the world. I mean, it's obviously a tool that advanced economies can use and are using, but we also saw a space for emerging markets. I mean, Brazil is not even an investment grade country. And now it's facing the consequences on the fiscal side, but obviously for investment grade countries in the EM space, the opening was there to do support packages, and in the case of Mexico, I think it was an opportunity that was not taken advantage of.
So with that, Alejandro, our time is over. We have lots more questions, but I think we have to move on. And I want to thank you for your outstanding presentation, for answering the questions so precisely. And I hope that we don't have to wait for a full year to hear you again, because I think there's so much going on in Latin America that hopefully we can do an update in 6 months or so, or 5 months or so, as to what the outlook is for the rest of the year and for 2022. As you noted, this is very challenging times for Latin America, but I can think of no one better in the world than you to be really leading the IMF's effort in Latin America with all of the challenges in front of us. So thank you so much. I'm going to give you a virtual applause as along with everybody else, and we'll move to the other part of our program. Thank you so much, Alejandro.
For the invitation, and surely we can, hopefully we can do it in person in the summer if things start improving sometime, the next few months. Thanks for putting this together, and thank you for, hosting us as always at the council. And thanks everybody for joining.
Thank you so much, Alejandro.